In the next 18 months, over 1.6 million UK homeowners are coming off a fixed-rate mortgage deal signed when rates were sitting at 2% or lower. Their new rate, if they can even get one, is going to be more than double what they're paying now. That's not a warning for the future. For a growing number of people watching this right now, that letter has already landed on the doormat. And here's the trap almost nobody explains properly before it's too late to avoid it. The rate you're quoted is not always the rate you actually qualify for. The timing of when you act changes the outcome dramatically, and the assumptions your lender is making about you right now might already be working against you without your knowledge. In the next few minutes, I'm going to walk you through exactly how the mortgage fix trap closes, the specific mistakes that make it worse, and what to actually do in the weeks before your fix ends, not after. I've been tracking the UK property market for years, and this is one of those situations where the difference between handling it well and handling it badly isn't luck. It's timing, paperwork, and knowing which questions to ask before you're standing in front of a decision with a deadline attached to it. Let's get into it. To understand why this moment is different from any previous remortgage wave, it helps to look at exactly what changed and when. The wave of homeowners now coming off fixed deals largely locked in their rates during a very specific 2 to 3 year window when the base rate sat at historic lows and lenders were competing aggressively for business by offering 2-year and 5-year fixes at rates that, in hindsight, will likely never be seen again in most of our lifetimes. Those homeowners built their household budgets, their spending decisions, in some cases their entire sense of what home ownership costs around a monthly payment that reflected that unusually cheap borrowing environment. The rate normalisation that's happened since isn't a temporary blip that's about to reverse back to those levels. It's a return closer to what mortgage rates have looked like across most of the last several decades, which means for many homeowners, the comparison they should be making isn't why did my rate go up so much, it's how unusually low was my old rate to begin with. And that reframing matters enormously for how you plan the next steps, because waiting for rates to fall back to where they were is for most people not a realistic strategy. The first thing to understand is what actually happens the moment your fixed deal expires, because most homeowners get this wrong. If you do nothing, absolutely nothing, your mortgage doesn't stay at your old rate. It automatically rolls onto your lender's standard variable rate, the SVR, which in the current environment typically sits meaningfully higher than almost any fixed or tracker deal you could arrange in advance. On a £220,000 mortgage, the difference between a competitive new fix and drifting onto the SVR can easily run to £300 or £400 extra a month, money that starts leaving your account the very first payment after your fix expires, whether or not you've done anything about it yet. Lenders are not required to warn you dramatically about this. You'll typically get a letter a couple of months out mentioning your options in the same tone as a routine administrative notice, not the tone the situation actually deserves. Consider a homeowner with a £220,000 mortgage who fixed at 2.1%, paying just under £950 a month on a 25-year term. If they take no action and drift onto their lender's standard variable rate, currently averaging somewhere around 7.5 to 8% across most major lenders, that same mortgage jumps to roughly £1,700 a month, an increase of over £750 every single month, or more than £9,000 a year, for the exact same property, the exact same loan, simply because no new deal was arranged in time. That gap isn't a rounding error. For most households, it's the difference between a manageable monthly budget and a genuinely difficult one, and it accrues from the very first missed opportunity to switch, not from some future point down the line. Here's the first trap: waiting until the fix actually ends before you start looking for a new deal. Most lenders allow you to lock in a new rate, whether staying with them through a product transfer or moving to a new lender, up to 6 months before your current deal expires. And crucially, if rates move during that window, you're often not locked into a worse rate just because you secured an offer early. Many product transfer and remortgage offers allow you to switch to a better rate if one becomes available before completion, without penalty. That means securing an offer early costs you nothing and protects you from the worst outcome, drifting onto the SVR while you scramble to sort things out under time pressure. Homeowners who wait until the last few weeks are the ones most likely to end up rushed, accepting whatever their existing lender offers rather than shopping the market properly, simply because there's no time left to do anything else.
Here's the second trap, and this is the one that catches people by surprise the hardest.
Your income and affordability position might have changed since you last took out a mortgage, even if your actual finances feel stable to you. Lenders apply stress tests, checking whether you could still afford your mortgage payments if rates rose further, and those stress test thresholds have tightened considerably compared to when many existing fixes were first arranged. A self-employed homeowner whose income fluctuated during a difficult trading year, someone who switched to part-time work, anyone who took on a new form of debt, a car finance agreement, a larger credit card balance, even something as ordinary as a new but unestablished income source can find that the same lender who proved them easily a few years ago now offers a smaller loan amount, a worse rate, or in some cases declines the application outright. This isn't necessarily about being irresponsible with money. It's about the fact that lending criteria shift constantly in the background, largely invisible to homeowners until the exact moment they need a new mortgage and discover the goalposts have moved. What makes this particularly difficult to plan around is that most homeowners have no visibility into where the goalposts currently sit until they actually apply, because lenders don't publish their internal stress test thresholds in a way that lets someone check in advance whether they'd still qualify for the same loan amount today. Mortgage brokers who work with clients approaching the end of a fix describe a recurring pattern. A homeowner who assumes their situation is essentially unchanged from a few years ago because nothing dramatic has happened in their life discovers during the application process that the combination of a slightly higher existing debt level, a marginally more conservative income multiple being applied by lenders generally, and a stricter view of certain types of income, bonus payments, freelance earnings, overtime, has quietly reduced their borrowing capacity by a meaningful amount, sometimes tens of thousands of pounds, without any single dramatic event causing it. Here's the third trap, and it's the one that turns a difficult remortgage into an impossible one. If your property has been revalued lower than what you paid or than what you assumed it was worth, and lenders routinely revalue properties as part of a remortgage application, your loan-to-value ratio gets worse even if your mortgage balance hasn't changed. A homeowner who bought with a comfortable equity cushion at 75% loan-to-value can find themselves recalculated closer to 85 or 90% once the new valuation lands, which pushes them into a completely different, more expensive pricing tier, or in the more severe cases, out of eligibility for standard mainstream deals altogether. This is exactly what's been happening across parts of the flat and new build apartment market specifically, where valuations have fallen noticeably in certain postcodes, turning homeowners who thought they had healthy equity into what the industry calls mortgage prisoners, unable to remortgage onto a competitive rate because the maths on paper no longer supports it, regardless of how reliably they've made every single payment. What makes this trap particularly frustrating for affected homeowners is that it has nothing to do with their own financial conduct. A homeowner can have a flawless payment history, a stable job, and a completely unchanged financial situation, and still find themselves reclassified into a worse pricing tier purely because the property itself is worth less on paper than it was when they bought it. Lenders reprice risk based on loan-to-value because a smaller equity cushion genuinely does represent more risk to them if the borrower were ever to default. But from the homeowner's side, it can feel deeply unfair to be penalised for a market movement entirely outside their control, especially when they've done everything right on their end of the arrangement. Here's the fourth trap, the early repayment charge miscalculation. Many fixed-rate deals carry an early repayment charge if you leave before the fix officially ends, sometimes a percentage of the remaining balance that can run into thousands of pounds. Homeowners trying to get ahead of the problem by remortgaging a few months early sometimes discover too late that their existing charge doesn't taper down smoothly. It can drop in large steps at specific calendar dates rather than shrinking day by day, which means the difference between switching on the correct date and switching even a week too early can easily be worth £1,000 or more, money that serves no purpose for the homeowner at all, simply a cost of not checking a single document carefully enough before making a move that felt at the time like reasonable proactive planning. Here's the fifth trap, and it's the one almost nobody mentions until it's already cost someone money, the convenient product transfer trap. When your existing lender writes to you near the end of your fix, they'll typically offer you a product transfer, a new deal with them directly, often marketed as the simplest, most hassle-free option. No new affordability assessment in many cases, no fresh valuation, minimal paperwork. That convenience is real, and for some homeowners, particularly those worried about failing a new affordability check elsewhere, it's a genuinely sensible route. But convenience has a cost. Lenders know that inertia is powerful, and product transfer rates are not always competitive with what the same homeowner could get by shopping the whole market through a broker. Homeowners who take the first product transfer offered without comparing it against the wider market frequently leave meaningful savings on the table, sometimes the equivalent of a full percentage point or more, simply because comparing felt like extra effort at a moment when they were already stressed about the process. There's a specific reason product transfers are marketed the way they are. Retaining an existing customer costs a lender far less than losing them to a competitor and having to win a new customer elsewhere to replace the lost business, which means lenders have a genuine commercial incentive to make the retention offer feel effortless and reasonable without necessarily making it the most competitive option a broker scanning the whole market could find. This isn't a criticism of any single lender acting improperly, it's simply how the incentives in the system are structured, and understanding that structure is exactly what allows a homeowner to use the product transfer as useful information, a real guaranteed fallback option, rather than treating it as the obvious or only choice. Now, here's what connects all 5 of these traps, and it's the part that makes this situation genuinely different from a normal, healthy mortgage market. Every one of these traps is worse specifically because they tend to arrive together in the same narrow window for the same homeowner. The valuation drop and the tightened affordability criteria often hit at exactly the moment someone's fix is ending because both are downstream of the same broader market conditions. The pressure to act quickly created by drifting toward the SVR is precisely what makes people less likely to shop properly or check the early repayment charge date carefully. This isn't 5 separate, unrelated risks, it's one interconnected trap where falling behind on any single element makes every other element worse, and where the homeowners most affected are disproportionately the ones who bought at the top of the market in the last few years with the least equity buffer to absorb a lower valuation and the least financial flexibility to absorb a higher rate. Here's what nobody puts together properly. The homeowners hit hardest by this aren't the ones who overstretched irresponsibly. They're often the ones who did everything conventionally sensible, saved a deposit, bought within their means at the time, kept up every single payment without missing one. The trap isn't a punishment for bad decisions, it's a structural feature of a market where the rules, the valuations, and the lending criteria all shifted substantially in the background during the exact years these homeowners were locked into a fixed deal and understandably not paying close attention to any of it, because why would you check the mortgage market weekly when you've got years left on a fix? That's precisely the gap this trap is built to exploit, not maliciously but structurally, because nobody is required to proactively update you on how much the landscape has changed while you weren't looking. There's an uncomfortable parallel here to how insurance and utility pricing has worked for years, where loyalty and inertia are quietly less rewarded than active engagement, except the stakes with a mortgage are considerably higher because the numbers involved are so much larger and the timing windows so much less forgiving. A homeowner who wouldn't dream of accepting the first quote from a single insurance provider without comparing alternatives will, remarkably often, accept the first mortgage offer their existing lender puts in front of them purely because the mortgage feels like a more complex, more intimidating product to shop around for, even though the financial stakes of getting it wrong are considerably higher. Here's how this plays out for the homeowners who get it wrong. They receive the standard letter from their lender a couple of months before their fix ends, set it aside meaning to deal with it later, and then find themselves 6 weeks out only to discover their income situation has changed enough to affect their options, their property valuation has come in lower than expected, and their early repayment charge window has just moved against them by a matter of days. Under that pressure, they take whatever product transfer is offered because it's the path of least resistance and the deadline is real. They end up paying more than they needed to, for longer than they needed to, purely because the process started too late to allow for proper comparison and correction. Here's how it plays out for the homeowners who get it right. They start checking their options 6 months before the fix ends, not because they expect to act immediately, but because it costs nothing to know where they stand. They request an updated valuation estimate early, so a lower number doesn't arrive as a shock at the worst possible moment. They check their own credit report and recent borrowing activity before applying anywhere, correcting anything that looks wrong and being deliberate about not taking on new debt in the months immediately before a mortgage application. They confirm the exact date their early repayment charge steps down in writing rather than assuming, and they get a whole-of-market broker to compare their existing lender's product transfer offer against everything else available, treating the product transfer as a flaw to beat, not an automatic default.
Here's how this plays out to the market level over the next couple of years. Expect a growing number of homeowners to fall into mortgage prisoner status, specifically because of valuation drops rather than payment history, particularly concentrated in flats and new-build apartments in postcodes already under pressure, which compounds an existing problem this channel has covered before. Expect lenders to continue quietly tightening affordability criteria in response to their own risk assessments, meaning homeowners who assume their previous approval guarantees a similar result next time are increasingly likely to be surprised. Expect product transfer rates to remain, on average, less competitive than the best rates available through full market comparison, because lenders have no commercial incentive to make the inertia option the cheapest option. And expect the gap between homeowners who prepare early and homeowners who wait until the deadline forces their hand to widen further, because in a tightening lending environment, time itself has become one of the most valuable resources a homeowner facing a remortgage actually has. There's also a slower moving consequence worth watching for over a longer horizon. As more homeowners get burned by one or more of these 5 traps, expect broker usage to rise further as a share of total mortgage transactions, because the value of independent whole-of-market comparison becomes harder to dismiss once enough people have direct or second-hand experience of what accepting the first offer actually cost them. That shift is already underway, and it's likely to accelerate, which is itself a quiet signal about how much trust in the simplicity of dealing directly with your existing lender has eroded over the past few years of rate volatility. If your fix is ending in the next year, the single most valuable thing you can do right now, today, not next month, is find out exactly when you can lock in a new rate without penalty and start that process immediately, even if you don't plan to switch for months. Get a realistic sense of your current property valuation before you need it for an application, so there are no surprises. Review your own finances honestly through a lender's eyes, not your own. Recent borrowing, income stability, existing debt, because that's the lens your application will actually be judged through. Confirm your early repayment charge schedule precisely, in writing from your lender, not from memory or assumption, and treat whatever product transfer your existing lender offers as a starting point for comparison, not a final answer, because the homeowners who come out of this the best aren't the ones with the simplest finances. They're the ones who started early enough to have real options, instead of running out of time and being left with whatever was still on the table. The mortgage fix trap isn't really about interest rates. Rates are just the headline. The actual trap is time, the gap between when the landscape quietly shifted and when most homeowners find out about it. And by the time that letter lands on the doormat, the homeowners who prepared months in advance are already through it, while the ones who waited are just beginning to understand how much the ground has moved beneath them. 6 months of preparation against 6 weeks of panic is, in almost every case, the entire difference between the two outcomes.